There is a conversation happening right now in a glass office somewhere in America. A financial advisor is sitting across from a middle-class couple, maybe in their late 30s, maybe early 40s, who have worked hard their entire lives and finally have some money saved up. They came in because they want to do the right thing. They want to grow their savings, protect their future, make smart decisions. They are nervous, a little overwhelmed, and they are trusting this person sitting across from them to guide them in the right direction. And that advisor is about to recommend a product that pays him a commission, not because it's the best product for that couple, not because the research supports it, but because the financial incentives of the system he works inside reward him for selling it. And the couple will leave that office feeling like they made a smart decision, like they're finally taking control of their financial future. And they will have absolutely no idea that the person they just trusted may have just cost them tens of thousands of dollars over the next 20 years. This is not a rare situation. This is not a few bad apples in an otherwise healthy industry. This is the structural reality of how the financial advisory business works in America. And understanding it might be the most important financial education you ever get. Stay with me through this entire video, because what I'm going to show you is not just about financial advisors. It's about a much bigger system that is designed at almost every level to move money from your pocket into someone else's. And once you see how it works, you will never look at financial advice the same way again. Let's start with something that most people assume is already true, but is actually not the idea that financial advisors are legally required to act in your best interest. It sounds like such an obvious baseline requirement that most people never even think to question it. Of course, the person managing your money has to act in your best interest. What kind of industry wouldn't require that? The financial advisory industry. As it turns out, there are two completely different legal standards that financial advisors operate under in the United States, and the difference between them is worth tens of thousands of dollars to you over your lifetime. The first standard is called the fiduciary standard. A fiduciary is legally required to act in your best interest at all times. Period. Full stop. They cannot recommend a product because it pays them a higher commission. They cannot steer you toward an investment that benefits them more than it benefits you. Your interest comes first, always, and they can be held legally liable if they violate that. The second standard is called the suitability standard. And under the suitability standard, an advisor is only required to recommend products that are suitable for you, not necessarily the best option for you, not the most cost-effective, not the one with the lowest fees, just suitable, meaning it has to be a product that is not completely inappropriate for your situation. That is an extraordinarily low bar. And the majority of financial advisors in America, the ones working at big brokerage firms, the ones you see advertising on television, the ones with the nice offices and the professional websites, operate into the suitability standard, not the fiduciary standard. This means that right now, today, a financial advisor can legally look you in the eye, listen to your goals, understand your financial situation, and then recommend a product that is mediocre for you but profitable for them, and they have broken no law and violated no professional obligation. They just have to be able to argue that the product was suitable. Not optimal, not best in class, just suitable. Now let's talk about fees. Because this is where the math becomes genuinely shocking and where most people, even financially educated people, underestimate the damage. The most common fee structure in the traditional financial advisory world is called a assets under management. Your advisor charges you a percentage of the total money they manage for you, typically somewhere between 0.5% and 1.5% per year. And on the surface, that sounds completely reasonable. 1% a year, in exchange for professional guidance and portfolio management. What's the big deal? Here is the big deal. Let's say you have $100,000 invested and your advisor charges 1% per year. That's $1,000 a year in fees. Still seems manageable, right? But here's what that fee actually costs you over time. Because of how compounding works, that $1,000 you pay in fees this year doesn't just disappear. It disappears and it stops compounding. Every dollar that leaves your account in fees is a dollar that will never generate returns. Over 30 years, at an average market return of 7% after the advisor's fee, that $100,000 grows to approximately $761,000. But if you had invested in a low-cost index fund with an expense ratio of 0.03%, which is what something like VU charges, that same $100,000 at 10% annual return grows to approximately $1,744,000. The difference between those two outcomes is nearly $1 million. $1 million created entirely by the gap in fees between a managed account and a simple index fund, not by better performance, not by smarter strategy, just by fees compounding against you for 30 years, the same way returns compound for you. And here is the part that makes this even more painful. The research is overwhelmingly clear that actively managed funds, the kind that financial advisors typically use to justify their fees, do not outperform simple index funds over the long term. Study after study, decade after decade, shows the same result. Roughly 85 to 90% of actively managed funds underperform the S&P 500 over a 15 to 20-year period. The ones that do outperform in any given year are rarely the same ones that outperform the next year. There is no consistent pattern of skill. There is only the pattern of fees, which are consistent, predictable, and always working against you. So how does this industry survive if the product it sells is demonstrably inferior to a cheaper alternative? This is the question that gets to the heart of the whole system, and the answer has several layers, each one more uncomfortable than the last. The first layer is complexity as a product. The financial industry has spent decades cultivating the idea that investing is complicated, risky, and something that regular people cannot navigate without professional help. And to be fair, investing can feel complicated. There are thousands of funds, dozens of account types, complex tax implications, and an overwhelming amount of conflicting information available online. But the complexity that matters for the average investor, the complexity that actually affects your long-term outcome, is much simpler than the industry wants you to believe. Buy a diversified low-cost index fund. Contribute regularly. Don't sell during downturns. Hold for decades. That's it. That is the strategy that beats 85 to 90% of professional fund managers over the long term. It takes about 15 minutes to set up and requires almost no ongoing attention. But you cannot charge someone 1% a year to manage a strategy that simple. So the industry manufactures complexity to justify its existence. The second layer is emotional management, and this one is actually legitimate, which makes the whole situation more complicated. Because here is the truth. A lot of people really do need someone to stop them from making terrible decisions during market downturns. When the market drops 30%, the emotional instinct is to sell everything and get out. And that instinct, if acted on, can permanently destroy wealth. A good advisor who talks a client off the ledge during a crash and keeps them invested is genuinely providing value. The problem is that this emotional management function does not require 1% of your assets per year. It does not require active fund management. It requires a conversation and some discipline. And you can get that from a fee-only advisor who charges a flat rate or an hourly fee without paying a percentage of your portfolio every single year forever. The third layer is the commission structure, and this is where the conflict of interest becomes most visible and most damaging. Many financial advisors earn commissions when they sell certain products. Annuities are a classic example. An annuity is an insurance product that financial advisors frequently recommend to retirees and pre-retirees, and it is also one of the highest commission products in the entire financial industry. Some annuities pay the advisor selling them 5, 6, even 7% of the total amount invested as an upfront commission. So if a couple walks in with $300,000 to invest and an advisor sells them an annuity, that advisor might earn $15,000 to $21,000 in commission from that single transaction. The couple will likely never know exactly how much the advisor made, and the annuity will almost certainly underperform a simple index fund portfolio over the same time period, while also locking the couple's money up with surrender charges that make it expensive to leave. Now, I want to be clear about something important, because this video is not arguing that all financial advisors are bad people or that professional financial guidance has no value. That is not the point. The point is that the system most financial advisors operate inside is structured in a way that creates fundamental conflicts of interest, and most consumers have no idea those conflicts exist when they sit down in that glass office. There are excellent financial advisors who genuinely serve their clients well. They are almost always fee-only fiduciaries, meaning they charge a flat fee or hourly rate for their time and advice. They do not earn commissions on products they sell, and they are legally required to act in your best interest. These advisors exist. They are findable, and for people with complex financial situations, business owners, people going through major life transitions, high net worth individuals with complicated tax situations, they can provide real, measurable value. But for the average American, someone with a steady income, a retirement account, maybe some savings they want to grow, the evidence strongly suggests that a simple, low-cost, self-directed investment strategy will outperform what most traditional financial advisors deliver net of fees over the long term. Not because those advisors are incompetent, but because the math of fees and the reality of active management make it almost impossible for them to add enough value to justify their cost. This connects to a bigger pattern that runs through almost every corner of the financial services industry, and once you see it, you start to notice it everywhere. The pattern is this: complexity and opacity serve the seller, not the buyer. The more complicated a financial product is, the harder it is to compare to alternatives. The harder it is to understand what you're actually paying, and the easier it is to obscure fees and conflicts of interest inside layers of jargon and fine print. Variable annuities with living benefit riders, whole life insurance as an investment vehicle, actively managed mutual funds with 12b1 fees buried in the prospectus, target date funds with expense ratios 10 times higher than comparable index funds. These products all exist inside a system that benefits from your confusion. Not your clarity, your confusion. And the antidote to that confusion is not finding a better advisor, although a true fiduciary can help. The antidote is education. Understanding how fees work and how they compound against you. Understanding the difference between a fiduciary and a suitability standard advisor. Understanding that the simplest investing strategy available, buying and holding a low-cost index fund, has a decades-long track record of outperforming the vast majority of professional managers. The financial industry is not going to teach you this. The advisor with a nice office is not going to explain the full math of how his fees affect your long-term outcome. The brokerage firm running ads on television is not going to tell you that their actively managed funds consistently underperform the index. That information is available. It's in academic research, in financial journalism, in government disclosures. But it requires you to go looking for it. And most people never do, because they assume the professional sitting across from them is already working in their interests. So what do you actually do with all of this? Because knowledge without action is just frustration. The first thing you do is find out what standard your current or potential advisor operates under. Ask them directly, are you a fiduciary? Are you required to act in my best interest at all times? If the answer is anything other than a clear, unqualified yes, you need to understand that the advice you are receiving may be influenced by factors that have nothing to do with your financial well-being. The second thing is to look at every fee you are currently paying on every account you have. Log into your brokerage accounts and find the expense ratios on every fund you own. Add up your advisory fees. If you have an advisor, calculate what those fees will cost you over 20 or 30 years using the compounding math we talked about. Most people who do this exercise for the first time are genuinely shocked by what they find. The third thing is to educate yourself on the basics of index fund investing. You do not need to become a financial expert. You need to understand about 4 or 5 fundamental concepts: how index funds work, how compounding works, how tax-advantaged accounts like Roth IRAs and 401 kiloseconds work, and why long-term holding outperforms active trading. That knowledge, applied consistently, will put you ahead of the majority of people working with traditional financial advisors. And if you do want professional help, if your situation is genuinely complex, if you're dealing with estate planning or a business sale or a major life transition, find a fee-only fiduciary advisor. You can search for them at napfa.org, which is the National Association of Personal Financial Advisors. These are advisors who charge for their time, not for the products they sell, and who are legally required to put your interest first. The financial system in America is not designed to make you wealthy. It is designed to make money off your wealth. And the first step to protecting yourself from that system is understanding exactly how it works. Now you do. If this video opened your eyes to something the industry doesn't want you to know, hit that like button and subscribe. We cover this kind of content every single week. And drop a comment below. Have you ever worked with a financial advisor? What was your experience? I read every single comment, and I'd genuinely love to know. See you in the next one!